Stop. Right now. Before you scroll past this, before you dismiss this as just another news story about a country you've never visited, I need you to understand something that nobody in the mainstream media has the guts to say directly to your face. This is not about Iran. This is not about missiles or nuclear sites or diplomatic deadlines. This is about the money in your wallet, the food on your table, the mortgage payment you're barely keeping up with, and the retirement account you've been quietly building for the past 20 years. Right now, as you watch this, two of the most terrifying pieces of machinery ever constructed by human hands are floating in the Persian Gulf. The USS Abraham Lincoln and the USS Gerald R. Ford, the largest aircraft carrier ever built by any nation in the entire history of civilization. Behind them, hundreds of fighter jets, dozens of warships, nuclear submarines moving silently beneath black water, and more than 150 military cargo flights that have already delivered weapons and ammunition into the Middle East in the past week alone. And just yesterday, 50 more F-35s, F-22s, and F-16s were sent screaming toward the region. The United States military is the most powerful, most lethal, most devastating fighting force in human history. And right now, at this exact moment, it is locked, loaded, and pointed directly at Iran. But here's what the evening news will never tell you. What the analysts in expensive suits dancing around on financial TV won't explain in plain language. What is happening in the Persian Gulf right now is not a geopolitical story that lives somewhere on a map you can't read. It is a money story. It is your story. And every single person watching this video is financially connected to this standoff, whether they know it or not. What happens in the next 10 to 15 days? The exact deadline President Trump gave Iran, later extended to 15, will determine what number you see on the screen at the gas pump next week. It will determine whether the Federal Reserve finally cuts interest rates this year or freezes them like a prisoner in a cell. It will determine whether your grocery bill stays where it is or climbs another 15%. It will determine what happens to the balance in your 401k. And it will determine whether the United States economy slips into a full recession before the end of 2026. Most people will watch this unfold, shake their heads, and go back to their lives. Those people are going to be blindsided. You won't be. Not after this. Before I show you the mechanism, the exact dollar-by-dollar chain reaction connecting a strip of water in the Middle East to your bank account, do two things right now. Subscribe to this channel and turn on every notification. This situation is changing by the hour. When the decision comes, and it is coming very soon, markets won't wait for a morning explanation. They will move in seconds. You need information the moment it happens, not a post-mortem 3 days later. And second, drop a comment right now. Tell me your city and what you paid the last time you filled up your gas tank. Write that number down. Remember it. Because that number is about to become a memory of a cheaper time. Let me take you back to where this fire was first lit. June of last year, 2025. Israel launched a shock military campaign against Iran. 12 days of warfare that shattered parts of Iran's nuclear program, killed senior military commanders, and turned missile production facilities into rubble. The United States didn't watch from the sidelines. American warplanes bombed 3 of Iran's most critical nuclear sites, Fordo, Natanz, and Isfahan. Trump looked into a camera and called them totally obliterated. The crisis eventually cooled. Oil spiked, then settled. Markets healed. Americans moved on. Iran did not move on. Iran moved underground. Satellite imagery from February of this year shows Iran using industrial-scale concrete and millions of tons of soil to bury and armor tunnel entrances at every major nuclear site. At the Parchin military complex southeast of Tehran, they completed a reinforced structure so thick, so deep, so impenetrable that weapons analysts have given it a name that sounds like it belongs in a horror story, a sarcophagus. They rebuilt the missile bases Israel destroyed. They ordered massive quantities of solid fuel components from China, the material that powers ballistic missiles, and they have been enriching uranium to levels approaching weapons grade, building what the IAEA called an unprecedented stockpile. Then January 2026 arrived and the streets of Iran caught fire. The economy had collapsed. Youth unemployment wasn't a statistic. It was an entire generation with nothing to lose screaming in public squares. The regime cracked down with violence. Trump saw the opening. On January 13th, he issued direct military threats. Iranian officials responded they were ready for war, and the crisis that now has 2 aircraft carriers stationed in the Persian Gulf began. Since then, every single one of these events has been verified and documented. Trump deployed the Armada, 2 carrier strike groups, a nuclear submarine, dozens of warships, hundreds of combat aircraft. He posted on Truth Social on January 28th that a massive armada was heading to Iran, moving with great power, enthusiasm, and purpose. On February 3rd, 6 Iranian IRGC Navy gunboats attempted to seize a U.S. tanker in the Strait of Hormuz. An American F-35 shot down an Iranian drone approaching the USS Abraham Lincoln. Iran conducted full war games inside the strait, not near it, inside it, essentially rehearsing its closure in front of American naval commanders, then announced joint drills with Russia. Trump set a 10-day deadline, then extended it to 15. Talks in Geneva lasted 3.5 hours. No resolution. And on February 18th, a Trump advisor quoted by Axios said something that should be the only headline in America right now. I think there is a 90% chance we see military action in the next few weeks. 90%. That is not a fringe voice. That is someone sitting inside the room telling you the truth in plain language. Now let me introduce you to the strip of water that runs your financial life, and that most Americans could not find on a map if their savings depended on it. The Strait of Hormuz, 21 miles wide at its narrowest point, sitting between Iran and Oman. And through those 21 miles flows 20 million barrels of oil every single day. According to the U.S. Energy Information Administration, that is 20% of all the oil consumed on the entire planet, every single day. It is not just crude oil either. A massive portion of the world's liquefied natural gas moves through the same channel. Qatar, the second largest LNG exporter on Earth, ships almost everything through Hormuz. Iran controls the northern coastline. They have missile batteries along that coast, submarine bases nearby, a naval force of fast attack boats, the same type that just tried to seize an American tanker. And for years, Iranian commanders have said it with complete public clarity. If America attacks Iran, the Strait of Hormuz closes. So the question that determines your financial future is simple. Would they actually do it? Every major investment bank on the planet is right now running 3 scenarios, and you deserve to understand all 3 in plain language. In the first scenario, the United States launches limited strikes on specific military or nuclear targets. Iran retaliates with missiles at U.S. bases in the region, as they did last summer, but deliberately avoids touching the strait. Why would they avoid it? Because Iran itself exports oil through Hormuz, and closing it would strangle their own dying economy. And China, which buys over 90% of Iranian crude, would be furious. Under this scenario, oil climbs from around $71 to $85 or $90 per barrel. Gas at the pump goes up 25 to 50 cents per gallon. Your monthly fuel costs rise $30 to $60. Inflation ticks up 0.5 percentage point. The Fed pauses rate cuts. Your 401k has a rough week and recovers within a month. This is currently what markets expect as the most likely outcome, which is why stocks have only fallen modestly, about 0.5%, over the past few sessions. The second scenario is the one that should keep you up at night. Iran closes the strait, or creates enough sustained chaos that it functionally shuts down for weeks, even months. 20% of global oil supply disappears from the market instantly. Shipping insurance for any vessel near the Gulf goes vertical. Tankers are forced to reroute thousands of miles around the southern tip of Africa, adding 2 weeks and enormous cost to every delivery. And oil prices don't just spike, they explode. Lombard Odier, one of the most respected private banks in global finance, released a detailed analysis this week. Their conclusion: closure of the strait pushes oil above $100 per barrel. Goldman Sachs agrees. JP Morgan's analysts went further, estimating a sustained blockade could send oil to $120 to $130 per barrel. The last time oil was at $130 was 2008. You remember what followed. What does $130 oil mean for you specifically? Gas in the United States averages around $3.20 today. When oil hit $130 in 2008, gas peaked at $4.11 per gallon. Adjusted for today's inflation, that would be over $6 per gallon. The average American drives about 15,000 miles per year. At roughly 30 miles per gallon, that is 500 gallons annually. The difference between $3.20 gas and $6 gas is $1,400 per year per driver. For a 2-car household, $2,800 gone. Not for anything you chose to buy, just to get to work. But gas is only the opening act. Here is what the Dallas Federal Reserve's own research shows about how oil shocks ripple through your entire life. Every $10 jump in crude adds approximately 25 cents to the cost of a gallon of gas, but it also raises the cost of everything that gets shipped, which is nearly everything you buy. Trucking companies pay more for diesel. Airlines pay more for jet fuel and pass it straight to ticket prices. Farmers pay more to run equipment and to buy fertilizer, which is manufactured from natural gas. Food processing plants cost more to operate, and every single price increase at every step of the supply chain ends at your register. Capital Economics estimates that if oil rises from $70 to $130, a 90% jump, you are looking at roughly a 1.8 percentage point spike in inflation. U.S. inflation currently sits at 2.4%. Add 1.8 and you are back above 4. And that assumes a quick resolution. If the strait stays disrupted for months, the inflation hit is larger, heavier, and it lasts longer. Then there is your mortgage. Here is the mechanism almost nobody explains. When oil prices spike and inflation climbs, the Federal Reserve faces an impossible choice: cut rates to support the economy, which borrowers and homeowners are desperately waiting for, or hold rates steady to keep inflation from getting worse. An oil-driven inflation surge forces the Fed's hand. Capital Economics wrote specifically about the Iran situation this week, saying strikes on Iran would risk causing oil prices to jump and threaten to reduce the pace or number of interest rate cuts by major central banks. If the Fed stops cutting, the 30-year fixed mortgage rate stays above 6.5% or climbs towards 7 or 8 in a severe scenario. Every quarter-point increase in mortgage rates adds roughly $60 per month to a $400,000 mortgage. That is $720 per year. For anyone who has been waiting to buy a home once rates came down, that door slammed shut. The third scenario is what serious analysts call the tail risk: low probability, catastrophic consequence. Iran retaliates not just against military bases but against oil infrastructure across the Gulf. Saudi oil facilities, which were already attacked by Iranian-backed forces in 2019, get hit again. UAE energy infrastructure is targeted. In this scenario, oil approaches levels not seen since the worst moments of the 1970s OPEC crisis. Adjusted for today's prices, that could mean $150 to $200 per barrel. The National Interest analyzed this exact scenario and concluded that with oil between $90 and $130 per barrel, combined with a weak dollar and gold at record highs, the United States faces classic stagflation: soaring inflation plus stalling growth plus rising unemployment. They called it a replay of the 1970s crisis, but on steroids. Every $10 jump in crude adds roughly 0.4% to inflation and subtracts 0.4% from GDP. At a $60 oil spike from 70 to 130, you are looking at a 2.4% inflation surge and a similar hit to economic growth. That is recession. Not a rough quarter. A recession. Now let me bring this directly into your investment account, because what happens to the stock market during a U.S.-Iran escalation is not random. There are specific sectors that get destroyed and specific sectors that surge, and knowing the difference is the most actionable thing you will take from this video. When the U.S. first struck Iran's nuclear sites in June 2025, the Dow fell 2% on the opening day, the S&P 500 fell more than 1%, the Nasdaq fell similarly. Tech stocks got hit hardest. Financial stocks fell. Consumer discretionary dropped. This is the classic geopolitical sell-off. Institutions dump equities and move to safety. We are already watching the opening moves of that pattern. On February 19th, the Dow fell 268 points. The S&P and Nasdaq each fell roughly 0.3%. These are modest moves because markets still expect a negotiated outcome. If strikes happen and the strait is threatened, the moves get larger and they happen faster than you can react. The sectors that get destroyed are the ones you probably own the most of. The S&P 500 is dominated by technology: Apple, Microsoft, Nvidia, Amazon, Google, Meta. Higher inflation and frozen interest rates reduce the present value of future tech earnings. A broader economic slowdown hits consumer spending, which hits advertising revenue. Geopolitical panic causes institutions to dump risk across all equities, and tech is the biggest category. Airlines get hammered immediately. Jet fuel is typically 25 to 30% of their operating costs. When oil doubles, that cost nearly doubles. Delta, United, American, their stocks fall hard in an oil shock. Retail companies with complex supply chains face higher logistics costs that crush margins. But defense stocks rally in every military escalation without exception. Lockheed Martin makes the F-35s being flown to the Middle East right now, 50 of them in the past 24 hours alone. Raytheon makes the missile systems on those carrier strike groups. Northrop Grumman and General Dynamics build the systems and submarines currently moving toward the Gulf. These companies see their order books grow when military action is taken. They rose during the June 2025 conflict. They will rise again. Energy stocks are the other clear winner. ExxonMobil, Chevron, ConocoPhillips. When oil goes to $100, their profits explode because they produce oil domestically at lower cost and sell it at the higher global price. And gold, which already hit $5,000 per ounce this week, driven partly by Iran tensions, is the ultimate crisis asset. Governments cannot print more of it. It cannot be frozen or sanctioned. In the 1970s oil crisis, gold went from $35 per ounce to over $800. In every major geopolitical catastrophe of the past century, gold has performed. If this escalates, it keeps climbing. If it de-escalates, it gives back some gains. But at $5,000, it is already telling you something. Now I want to say something clearly so there is zero confusion. I am not predicting war. I am not predicting that the strait closes. I am not telling you gas will hit $6. The base case among credible analysts at Lombard Odier, Capital Economics, and Goldman Sachs remains a negotiated agreement or a limited military strike with minimal disruption, similar to June 2025. The VIX, the fear gauge of the stock market, is still below its long-term average, which tells you markets are not pricing in catastrophe. They are pricing in elevated uncertainty, but not collapse. But the risk of something worse is not theoretical. It is not a hypothetical model in a spreadsheet. It is happening in real time right now, with documented events that occurred in the past 3 weeks. A Trump advisor said 90% chance of military action. Iran is constructing concrete sarcophagi over its nuclear facilities. Iranian gunboats tried to seize an American tanker. A U.S. F-35 shot down an Iranian drone. These are facts, and they exist inside a historical pattern that is never once broken. Every major oil disruption centered in the Middle East, 1973, 1979, 1990, 2008, has reached directly into American living rooms and emptied American wallets. Not because Americans are uniquely vulnerable, but because oil is the blood of the global economy and the Strait of Hormuz is its single jugular vein. What makes this moment potentially more manageable than the 1970s is that the United States is now the world's largest oil producer, over 13 million barrels per day domestically. We have the Strategic Petroleum Reserve. We have LNG exports that give us leverage. We are not the helpless dependent importer we were 50 years ago. That reduces the severity of the blow if Hormuz is disrupted, but it does not eliminate it. Oil is a global commodity with a global price. When it spikes in Rotterdam, it spikes in Houston. When it spikes in Houston, it spikes at the station down the street from your house. So here's what you actually do right now. Not panic, prepare. If you fill up your tank once a week, consider filling it today. Lock in today's price. This is not hoarding. It is basic economic planning that every rational actor does when prices are transparently about to rise. If you have a large purchase planned, furniture, appliances, electronics, consider buying now rather than waiting. Retailers reprice shipping costs within 60 to 90 days of a sustained oil spike. The couch you see today is priced with today's diesel. At 30% higher diesel, that price goes up within 2 months. Review your investment allocation. If you are heavy in tech and light in energy and defense, ask yourself whether that balance reflects the world you are actually living in right now. A small position in an energy ETF or a defense ETF is a reasonable hedge that doesn't require you to be right about the outcome, only to be protected if the worst scenario materializes. If you have been waiting for interest rates to drop before refinancing or buying a home, understand that the Iran situation could delay those cuts significantly. Do not make a housing decision built entirely on the assumption that rate cuts are arriving on schedule, and build your cash buffer, 3 to 6 months of expenses in a high-yield savings account. In a period this uncertain, cash is not a great investment. Inflation eats it slowly, but it is protection. It means you are never forced to sell your best assets at the bottom of a panic just to pay your bills. There is one more domino that almost nobody is connecting to this crisis: the dollar. When the United States enters armed conflict, the dollar initially strengthens as the global safe haven currency. But sustained conflict that drives inflation and forces the Federal Reserve into an impossible position between fighting inflation and supporting growth, can weaken the dollar over time. A weaker dollar means everything imported costs more. The United States imports over $3 trillion in goods annually. A 10% drop in the dollar's value means everything imported costs 10% more on top of any existing tariffs. It is a compounding pressure that hits your household budget invisibly, with no label on the receipt, no line item explaining it. You just see the number go up and you don't know exactly why. Iran's foreign minister said this week that Iran knows a military option would only bring disastrous consequences, not only for us, perhaps for the whole region, and for the whole international community. That language is deliberate. It is a signal that Iran wants a diplomatic exit if Trump will let them take it without losing face. But Trump has also put his credibility publicly on the line. He sent 2 aircraft carriers. He named a deadline. He told the world that if Iran doesn't agree, something very tough and very traumatic will happen. Backing down without a deal is not something Trump does. So the next 15 days are genuinely among the most consequential in recent American economic history. Not for geopolitics, for your money. The people who understand how the Strait of Hormuz connects to oil prices, which connects to gas prices, which connects to grocery prices, which connects to inflation, which connects to interest rates, which connects to your mortgage, your investments, your grocery cart, and your paycheck. Those people are already making decisions. They are filling up their tanks, they are reviewing their allocations, they are making sure they have cash, they are staying informed from verified sources rather than waiting for the story to become obvious after the damage is already done. The people who don't understand this connection will look at their gas receipts in 2 weeks and wonder why everything got more expensive overnight. They will check their 401k and not understand the number. They will hear Iran mentioned on the news and not connect it to the bill they just paid at the grocery store. That gap between people who understand how these systems are connected and people who don't is exactly why this channel exists. Subscribe. Turn on all notifications. Share this with one person who needs to see it before they make a financial decision in the next 2 weeks. And leave a comment telling me your zip code and what gas costs there right now. I want to track the numbers across the country in real time as this develops. The Armada is in the Persian Gulf. The deadline is 15 days, and your bank account is watching whether you are or not.